Hello everyone, today I'm going to talk to you about budget and funding. I'm just going to quickly go through the main points. I'm not going to go through like every single slides. So the main point I'm going to talk about is the why do you have budget, how are you going to do budget, and different types of funding you can get and different kinds of sponsorships. Alright, so let's start now. So we're gonna talk about accounting basics now. I'm gonna introduce you to different types of accounts that we um, gonna see in projects. But why are we doing all this? Is because we need to record down every single entry to actually to let all the stakeholders understand what you're going through in this project. What are the things that what are the spendings, and then like what are the incomes, and then you need to summarize and report to your stakeholders. That is why uh, that is the whole purpose of doing financial accounting. So the primary financial statements, there are like income statements, balance sheet, and statement of cash flows. So you can quickly read up the income statement. I have already included the PowerPoint slides on mail, so you can actually read about them. But for income statement, in summary, is that it shows how much the business earned during a period of time. So this is what you actually list down all the income minus all the spending. Okay, so this is basically what income statement is. It can actually span from a week, a month, 3 months, 5 weeks, or a year. So yeah, it really depends on how long your project lasts. Okay, so basically from your income statement, we can find out what your net income is. So it's basically your revenue or your gain less expenses and losses. All right, so this is the formula. So this is how it looks. So you list down all the revenues and gains. Let's say your sales, your interest, and then your gain on sales of assets. Let's say what is asset? It's like actually like a maybe a piece of furniture. Maybe you have a table, and then you no longer find that table useful, so you sell it off as second-hand item to some other people, and then you get like $3,000 in return. So that is actually counted as your revenue and gain as well. So apart from that, you also have like expenses and losses, like cost of goods sold, meaning that you have to buy in stocks and all that, and then like if you have if you employ salesperson and then you have to pay them commissions, that is also expenses. And then you have to buy in office supplies, equipments, and then you have to do advertising and all that. So all that adds up as your expenses and losses. So that 10800, I mean like 108,000 minus that 90,000 expenses, that means you have like net income of $18,000. All right, so this is basically an example. So the second account that you usually see in a project is a balance sheet. When you say balance sheet, right, you have to make sure that your asset and liabilities are balanced. Okay, it's a snapshot of a company's financial position. Okay, so the main thing that you see in balance sheet is um, assets and liabilities, and then sometimes stockholders' equity. Okay, so assets are things that a company own. Let's say like fixture and fitting, a piece of furniture like I mentioned, a chair, a table, or a fridge, or like a water dispenser, coffee maker. All those are assets. Liabilities are things that uh, let's say depreciation of a car, or money that you owe other people, or owe other uh, payable to other companies. Okay, stockholders equity, I don't think you have them, so we can actually skip that. So this is a very simple balance sheet that you see. So Here asset, they put cash as their asset, so $20,000. Liabilities, uh, stockholders equity, common stock, $20,000, so it's balanced. All right. So vehicles and cash makes up for $20,000. That can also be like balanced with the liability. So this is a much more complicated looking balance sheets. Like you can actually go through all the items and entries, but I don't think yours is as complicated as this one. And then the third one, the third account that you usually see is statement of cash flow. It shows how cash amount has changed during the time interval shown in the heading of the statement. So I don't have like an example, but actually it's like a cash book. Okay, you can actually Google for it, a cash book, meaning like the debit and credit, how much money you have, how much money you spend. So by the end of the day, you will know like how much money you spend and how much cash you have in hand. All right. Resource identification. There are 5 basic groups of resources in any project: knowledge and skills, facilities, equipment, material, and special resources. So when you go through WBS, you should actually know like what resources that you need. So in order to help you all, you can actually use this matrix, resource identification matrix. You can actually put down what you need and then what resource you need. All right. So let's say this resource table, you have pre-production, and then in that stage, right, you have script, and then you have to hire key production personnel, and then you have to do casting. So all this are the resources that you need. So resource identification also like states down the quantity and then the quality and quality of the resources needed. Sorry, there's a spelling error. Then you have to estimate the amount of the cost, then the man days, anything that is related to the project should be factored in. Then the benefits, what benefits can they bring to your project? Okay, so when we talk about resources, right, directly, I mean, straight away you will think about budget. And budget is very, very important to your project. Why? Because after only after you have your budget, you know how much to actually ask for when you go for like when you pitch to your maybe funding when you pitch for funding. So let's say you want to go to a sponsor and then you want to ask for like funding or sponsorship of things. If you don't have a budget, how do you know that how much you should ask for? So budgeting is very, very important. So it's basically an itemized summary. All costs anticipated to occur during the implementation over a specific period of time. All right. So basically, you need to break all the items down. Let's say your script, right? The cost of your script is how much, and then like when you need to hire key production personnel, you have to let them know that so who will be uh, what are the roles that you have, okay, and how many, and then like how much will they cost. Casting as well, like casting manager and assistant, how much do they cost? So yeah, a typical budget includes direct and indirect costs. What do I mean by that? Direct cost is like labor, materials, travel, subcontract. Indirect cost is like, let's say employee benefits, their holidays, their insurance, and then like low hay, things like that. Cost of a project can be estimated in a number of ways, top down and bottom up. So I have a video with me that actually explains what is top down and bottom up. You can actually refer to that video, all right? And let's look at the sample projection. One thing I want you to take note of is budgeting, right? You do not do like budgeting as precise as possible. Let's say you're gonna like buy food, right? You don't go to the hawker center and then see that okay, one plate of duck rice is 350, and then you come back and say okay, I have a crew of 10, so I'm gonna budget in 350 times 10%. No, you have to actually uh, mark up a little bit, like 350. Let's say you have like then you estimate it to be 4. What if you don't go to that particular store? You go to another store, a store. So that store may sell you duck rice at $4 a plate. And then like, what if you have like extra crew member? And then like how many days of shooting you have? So you have to actually factor all that in. So maybe instead of 350, you put in like 400 or 450. So every single item you mark up a little bit, a little bit. So by the end of the day, I mean like as the total budget amount, right? You have a leeway, like you have a space, you have a room. Uh, let's say if you like, overspend a little, you still don't like, overspend a lot. That means like you don't overspend like crazy. Yeah, it's still within your budget. All right. So sometimes people will also uh, your stakeholders will also ask you for your ROI. So what does it mean? ROI means return of interest. It's a percentage. So the formula is like this. Assuming your cost is 200,000, then your profit would be 255,000 minus the cost. So 55,000 is your net profit. So your 55,000 you multiply by 200,000, 27.5% is the ROI. So when they ask you, then you will say, oh, the return of interest is about 27.5%. Okay, so that's what ROI is. So funding sources, right? We have different funding sources. We have like financial sponsors, in-kind sponsors. Do you know what it means by in-kind sponsors? They don't really like give you money. Let's say they link you up with their partners, and then their partners eventually sponsor you, like fund you. You know that network, right? The relationship that they help you to build is in-kind sponsorship. Or you actually go to NLB and then you ask for sponsorship for the venue. They don't really like give you money because sponsorship doesn't necessarily come in as money lah. So they can actually just sponsor you with a location. That is also a kind of in-kind sponsorship. All right. Media sponsorship, let's say you go to Joe San or 95, 98.7, and then like, you know, they sort of like help you advertise and promote or publicize about your event, and then they don't like charge you a cent. That is media sponsorship already. Or like let's say 早报, they cover your event and help you publicize. That is media sponsorship as well. So location sponsors, label sponsors. What does it mean? Like let's say you have an event, you need a barista to come and help you make coffee. So if the company sends the barista to come over and help you make coffee during the office hour and don't charge you a cent, that is label sponsors. So what is signature sponsor? Actually, during like your project, right, you can actually think about what are the benefits that the sponsor can enjoy. Usually sponsors, right, there are different levels of sponsors. Signature sponsors means that they are the main sponsors. They actually enjoy the most benefit. So it is also very important that when you go to a sponsor, you actually tell them in exchange, right, what benefit do they enjoy? What can they expect in return? So if they sponsor you with this, and all that, maybe their name will be mentioned when there is media coverage. Or like if they sponsor you with more, then their names will be printed on collaterals. And then like if they like really like sponsor you with a lot of stuff to become the signature sponsors, then maybe you can have like a stall or booth for them on the event day so that they can actually sell their stuff over there. I don't know. So do actually talk to them and coordinate, I mean like discuss with them when they show interest. You can actually, before they even show interest, and let them know, what kind of benefit or what kind of things they can actually um, expect. All right, that's it. So I hope you go and watch the video.